Just so you all know, I'm showing you how to take back control of your money because I'm giving you the controls. I'm taking controls away from your advisor, away from your 401k provider who gives you terrible advice in most cases. I'm giving you the controls. Building wealth is about how much you keep. I'm just trying to show you how to keep the money. I'm trying to show you how to be in control of the money. Folks, like I've done my research on IULs. They will fail just like the Universal Life failed, just like the VUL failed. These are next. Welcome everybody to another episode of Wealth Webinar, where we talk about the truth about money. We show you all how to take back control of your money, and we do it by having some fun, and that's what we're going to do today. Today, I'm going to cover two main topics. We're constantly sitting here talking about where we're at in the economic cycle. If any of you are watching any of my YouTube videos, following me on any of the social platforms, and if you're not, little shameless plug here, make sure you at least subscribe to my YouTube channel, which is at the Chris Naugle. Throw me a like, hit that little bell so you can be part of some of the lives. But all of my content is designed to teach you the things that no one else will ever show you about money. The things that when I was an advisor for 16 years and when Stephen was a financial advisor, we weren't even taught this stuff. And even if we were taught this stuff, we probably wouldn't have talked to our clients about it because we couldn't make money on most of what we teach. And one of the things that we're going to talk about today is absolutely the main fundamental thing that you all should be told by your advisors. Maybe some of you are, but I know many of you are not, and that is buy low, sell high, and don't lose money. You see, that's a Warren Buffett statement. And if you buy low, which all of you have been doing, and here's the beauty, like literally, if you bought last year, you bought low. If you bought the year before, you bought low. If you bought the year before, you bought low. If you bought the year before, and most of you have, because you have 401ks, IRAs, some of you have systematic investments, but that's the gist, right? You're putting money in the markets, whether or not you know, like, and understand what you're investing in, you're buying low. That isn't the problem, okay? I'm not here to teach you how to buy low. I'm here to teach you the one thing that no one seems to do, which is fundamentals. No one sells high. Because if you buy low and you sell high, you can't lose money. So I'm just going to quickly open today up by showing you some really easy 5th grade things to show you how to know where a stock, a mutual fund, or an ETF is going, where it's been, and where you should probably exit. This is going to be a really easy exercise right now because we are sitting at all-time highs, or at least a little bit off the highs. So it doesn't matter what we look at, but I'm going to require involvement from all of you, our audience. So we've got almost 80 people on here, and we'll have over 100 as we get rolling. I need to ask all of you for a favor. Are you willing to participate so I can make this really fun? Put I in the chat if you're willing to participate and help me do this. Come on. All right. We got some takers. There we go. Stephen, we got some participators. All right, so here's what I want you all to do. Stephen, you're going to kind of be my set of eyes on this. I want you to put just a stock, a ETF. Maybe it's one you have. Maybe it's one you're sitting looking at and like, man, when do I sell this thing? And that's what we're going to do. But I'm going to open up today, and I'm going to literally do this just because I don't want you to think this is all pre-done. I want all of you, so right there, Rick, put that over there. I want all of you to see that it doesn't matter what stock you put out there. It doesn't matter what ETF you give me or what mutual fund you give me. The fundamentals, what Warren Buffett invests based on, fundamentals, are all that matter. You see, we're not going to go deep into fundamental analysis. If you want to do that, read Warren Buffett's books. All I'm going to teach you today is a thing called support and resistance, which is literally 5th grade stuff. Here's the other day, I'm so proud of my little daughter. She's 4 years old. My daughter was drawing, and you know, kids at 4, they draw shapes, right? She was drawing shapes. She had triangles, she had circles, she had squares. But for the first time, my daughter had a ruler. And my daughter was putting a ruler on the thing, and she would take the ruler and she would draw straight lines over. How many of you on here can draw a triangle? How many of you can draw a circle? How many of you can draw a square? And how many of you can draw a straight line? The answer is every single one of you, which is why this will not be a problem of what we're going to cover today. And after I'm done showing you this real quick segment, because it's not going to take up the whole time, I'm going to get into one of the things that came to me this morning when I was showering after my run. I'm showering, I'm doing my hair, and I just got this idea. And I'm just like, you know what? We always assume every one of our followers, everybody that's on the webinar understands the different types of life insurance there is out there. We all think that everybody understands IULs and the difference from whole life or VULs or ULs or term, but I'm just going to draw it like a fifth grader. Is that cool? I love it. So everybody's got their stocks in there. So here, let's dive right into this thing. I got a couple things I want to pull up, and I want to start with one. Now, all of you, if you've been around this campfire, and I know there are actually here real quick, let's test the room, Stephen. How many of you are here for the very first time? Put first in the chat. I just want to see how many of you are first timers. I know we had a couple. So let's see, first timers. Let's get them up on the screen. I just want to see how many we got. Perfect. Okay, we got Ken, we got Jen, Ivy. If you've been around this campfire, and if you're brand new, it's fine. I'll explain it. You know that I talk a lot about treasury bonds. Okay, and I talk about treasury bonds primarily because right now is a great opportunity. It's a great opportunity, but instead of me telling you why or all those different things, I thought I would just pull up a chart. See this right up here? This is an ETF. And the reason I'm not going direct to treasurydirect.gov is because I'm going to just show you a simpler way. This is what I buy. I'm not making a recommendation, not giving you investment advice. We don't get paid to do that, just so you know. This is an ETF that I own a lot of in my portfolio, and I have been buying it strategically to buy low. Now, let's just talk about TLT. What is it? Well, it's treasury bonds. That's all it is. It's a treasury bonds, and here, I don't know. All right, so on this is 20+ year treasury bonds. So this ETF, which stands for Exchange Traded Fund, not important. All it is, it's passive. These investment companies, this one's iShares, goes out and they buy treasury bonds, and they make it real easy for you to participate or to invest in treasury bonds because they just buy a bunch of them. And in this one, they bought a bunch of treasury bonds that are, you know, if you blend them all together, are an average of 20+ years, which is critical. In order to do what I'm about to show you, or for what you're going to see, this only works with long duration bonds, okay? Bonds that are 10+ years out, which, let me just explain a bond for any of you that don't understand them. Let's just say you got $1,000, okay? And you want to give me that $1,000. I create a bond, which is an IOU. Essentially, I write IOU on a piece of paper. I know you can't see the screen, but I'm just going to write IOU $1,000. And let's just say we do this IOU for, I don't know, 10 years. And during that 10 years, I put what's called a coupon. Think of a coupon like you're just going to clip every month, you're going to clip coupons that are every quarter. You're just going to go and you're going to tear off a coupon, and you're going to use that coupon to get a check. That's essentially kind of where that name came from. You're clipping coupons. That's all you're doing. And some of you are old enough to understand coupons. I grew up with like one of those little almost Rolodex things where mom had all the coupons for all the different things. My grandpa was the king at that, but that's all you're going to do. And the coupon, let's just say, is 5%. So you give me the $1,000, I give you an IOU back, and it says I owe you $1,000 in 10 years from now, but during that whole 10 years, I'm going to pay you 5% annually. Okay. And I'm going to do that on a quarterly basis. So every quarter, you can clip one of your coupons, and I'm going to send you a check, which is equivalent to the 5%. That's essentially what a bond is. I drew it on the board, so we'll look at that in a second. So does everybody understand that? There's nothing complicated. Now, all different companies, municipalities, and the government all do these things. They all do bonds. Now, the bonds from the United States government are the easiest ones to talk about because they're backed by the full faith and credit of the United States government. So this ETF, okay, is buying those bonds, not directly holding the bond from the United States government, but buying an ETF, a fund that has those bonds in it of 20+ years. Now, here's why, and here's what we're going to do. We're going to just look at different periods of time. Can anyone tell me, we're going to focus here first, what happened in 2008? Go. What happened in 2008? And I love this. That's right, a recession happened. Now, this is going to get a little bit more complicated, Rick. For a t-shirt, what was the first thing the Fed did when we had the definition, which back then was the definition, but when we had the definition of a recession, what was the very first thing? That's right. So Rick Smith, give me your address and your shirt size over in the Q&A, and I'll send you a t-shirt. See, this is how I get people to participate. So hold on. Now, every one of you got this right. Rick was the winner because he was quick on the draw. In 2008, there was a crash. It was called the Great Recession. So we went into a deep recession, almost a complete failure of the financial system. The first thing the Fed did in their toolbox is they pulled the lever for interest rates and they dropped interest rates down. All I want to do is I want everybody to really focus on this period right here, okay? This is the price, just so everybody knows. These green and red lines, red just means it's going down, green means it's going up. That's the price of this particular fund, which are treasury bonds. Can anyone tell me what did the price do when the Fed dropped interest rates? Can't give you a t-shirt for this one. It's too easy. That's right. Daniel nailed it. It went up. No, Brian, real quick. Hold on. Let's make sure we got this. So Rick and Daniel got it. But Brian, just take a look at what I just drew right here. This is up. So when the Fed dropped interest rates, we can see it right here, okay? If I went, and you can't see when it is, but you can see the volume spikes. I'm not going to get technical, but right here is when the Fed dropped rates. And they went from, I don't know where we were at, let's call it 4 to 6% on the rate. They dropped it to almost zero. And what happened to the price, folks? Can anyone tell me what happened to the price? We went from down here, which is about $98, you can kind of see here, about 98 bucks on this line right here. And it went to, where do we go up to? 120? See, I'm looking over here. I got to decrease the size of the screen a little bit, but I'll get to there, about 120. Can anyone tell me, would that have been a good investment in that short little period of time from there to there? Sorry, my lines aren't great. Would that have been a good investment for you all? If you bought it at around $98, let's say you didn't even get in right at the top. You bought it from right here, $98. You didn't get in at the bottom, and we're not going to get out at the top because we're going to sell it about $1.18. $18 per share on something that is guaranteed by the full faith and credit of the United States government. Is that good? Anyone like that? Yeah, right? Of course. But it's so easy for us to always just go back in time and just talk about things that happened in the past. So I'm just trying to make a point. Now, hold on. Then this is tricky. This is really tricky. But let's come over here to this period of time right here, because I know this is going to be a little bit easier for everybody. Can anyone tell me what happened in late 2019? What happened in late 2019? COVID, right? Daniel said COVID. What did the Fed do when COVID hit and we entered, truly, we entered a recession, but they changed the definition of recessions. We covered the hell out of that. They dropped rates. Can anyone see what happened when they dropped rates? We went from about 118, see this blue line, I drew those lines, about 118 to a high of 179.79, but let's just go to 164. Now, hold on. Can somebody grab a calculator? Let's just do the math. And now I want to show you something. So we went from, I'm just going to do this line here, 118, okay? We went from 118 to, I don't know, I'm just going to use this line because it's easy, 164. 164. It's a $46 move in price. $46, okay? Now, what kind of, does anyone know what kind of, for a t-shirt, who can tell me what return that would be if somebody had bought treasury bonds right around this 118 mark right here, and then when the Fed dropped, and it wouldn't have bought, you could have bought anywhere in this range right here, and then when the Fed dropped interest rates, price went up to 164. If you made $46 per share, and you paid 118 per share for a t-shirt, who can tell me what the return would have been on that investment? Stephen, let me know when we got a winner because we need to get their address. 46 divided by 118. Okay, there we go. Daniel got it. So Daniel, give us your address and your shirt size. 38%, 38%. But it wasn't 38% over 5 years, 10 years. It was 38% in 1 year. Notice this, actually less than 1 year, really. But see, from this time here, 19 to 20, we'll just go to 20. It was a 1 year move, and you made 38%. How many of you would have loved to have known about this back in 2019? All of you would have, right? Because that's a 38% move in price. You just take $46, which is the gain, divided into the price you paid. That's the simplest way to just calculate the return. Okay, so the point I'm trying to make here, and I'm just trying to get you to understand, this is buying low and selling high. Now, what would have really sucked is if somebody bought at 118. Hypothetically, I mean, you could say you bought low. Bought it at 118, you bought low. But then it went up to 179, came back down to 164, and the advisor didn't call you, and you forgot all about what Chris Naugle and Stephen Nagy taught you at this wealth webinar, and you just held the treasury bond. it would have went from 118 down to, what, I don't know what the price down here would have been. Let me just, there we go. Would have went down to $97. How many of you would have been really upset if you bought an investment that went from 118 to $97? That would suck, wouldn't it? But what would even suck more is if you bought it at 118 and it went to 164 and you didn't sell and then it came back down to 97. Wouldn't that really suck? That'd burn your butt, wouldn't it? Absolutely. So here is what I'm trying to make the point of. There's lots of good investments. There's lots of bad investments too. But when it comes to stocks, mutual funds, ETFs, they always tell you, advisors are always taught to tell you, buy and hold for the long run. I'm not saying there's anything wrong with that. But what they fail to tell you is also buy low and sell high. Now, if your money is held in a retirement account, if you bought it at 118 and you sold it at 164, how much would you pay in tax? Nothing. Okay, you wouldn't, because it's deferred. The taxes are deferred. Okay, so it wouldn't matter. If you bought it in a brokerage account and you sold it, yes, you'd pay tax between 118 capital gains and 164. And if Kamala gets in the office, she is proposing that you will, well, if any of you are 100 million or more, you will pay tax on the unrealized gains, whether or not you sold them or not. And I don't know what her plan is let's say somebody had a stock, they bought it at 118, in the calendar year it went to 164, but then the next year it dropped down to $97. Like, can you go back to the IRS and say, hey, listen, you taxed me on those unrealized gains, but I held the stock and it's now at $97. Can I write that off? I mean, somebody's got to be asking these questions. Might as well be me. It's like, hey, if you're going to tax us on unrealized gains, if we don't sell it and it goes lower, can we petition for a tax write-off? Just asking for a friend. Yeah, I'm being for real on this stuff. So buy low, sell high. Buy low, sell high. Buy low, sell high, and you can't lose money. This move right here would have only been good if you sold somewhere around this range. And I don't care where you sell. You're not going to get it out. You're not going to get out at 170. Let's be real. You're not sitting in front of a computer watching it. But how about right here? Right now, as of today, you can buy right around $97. Now, if in September, the Fed drops rates and they continue to drop rates into 2025, because we probably will go into a recession, what do you think is going to happen to the price of this bond? Who can tell me what will happen to the price of the bond? It will go up. The question is where will it go? I don't know. Does it even matter? No. Because some of you would buy it today or whatever it's at today, we'll look, at $97 and you'd sell it at 118 and you'd be happy. Maybe you'd even send us a card saying, hey, Chris, I watched your training. Thanks so much. I made $20 a share, a little more than $20 a share. Thank you. Some of you would wait and you'd hold it to 140. Now, does it matter where you sell? No. Stop trying to get the top and stop trying to get the bottom when you buy. Just buy low and sell high. It doesn't say buy at the lowest, sell at the highest. It just says buy low, sell high. So folks, like, listen, I'm going to show you, I'm going to use everybody else's stocks. Steven, I think you got them all there. Okay. I'm going to show all of you how we're going to do this with any stock you give me. The same exact thing I just did here, we're going to do with any stock you can give me. And I think the one thing that's going to become very apparent is some of you folks need to start selling some stock and taking your gains off the table, because folks, things aren't looking so good on the forefront of the markets. That's all I'm going to tell you. Okay. They might look good today. You might be like, well, I just looked at it today. It's actually doing pretty good. You're right. It's doing pretty good until it's not. And that's what we need to focus on. That is exactly what we need to understand and what we need to focus on. So now what I'm going to do is I'm going to pull up my trading platform. You guys can use whatever you want. I use Thinkorswim, which is Charles Schwab. Okay. So, and how we're going to do this is I'm just going to go in. Steven, you're going to give me tickers, and we're going to do that same thing while I share the screen. Does that sound good? And we're only going to do this for a little bit with a couple of them. I'm not going to get to every single one, because some of you are here to learn how to be the bank. Some of you want to take back control of your money. And folks, just so you all know, I'm showing you how to take back control of your money because I'm giving you the controls. I'm taking controls away from your advisor, away from your 401k provider who gives you terrible advice in most cases. I'm giving you the controls. Hey, why don't you drive for a little while? Because now you know how. Now you know, like, and understand what you're investing in, because you know this is how you do it. And all of you can do this. You could just go to Google and you can punch in this stock, Tesla stock chart. And we can just grab a ruler and we can just draw some lines, print it out and draw some lines. But Steven, give me one stock that somebody wanted to hear about.
Tesla.
Tesla. TS. Okay. TSL. There we go. Here we go. Let's do this. So the first thing, share my screen. We all know Tesla. Some of us love it. Some of us hate it. I love Elon, but I don't like electric cars. Now, what I'm going to do is to make this super simple, I'm just going to go to the longest period of time. I'm going to do 5 years. Actually, let's do 15 years on Tesla. All right, there we go. There's 15 years. Now, again,
Tesla's I think you're looking at the wrong. Tesla's TSLA.
I do. I'm sorry. Thank you.
I think you're in a yeah.
What is the ticker for Tesla? Is it? I thought it was
TSLA.
TSLA. I missed the A. There we go. Thank you. 15 years. Perfect. So let me get my little drawing stuff going here. Draw trend lines. But we're just going to call this ruler lines. Is that okay, folks? We're just going to draw ruler lines because I know some of you don't have the charts that draw the lines. So how many of you wish you could have bought Tesla here? Joking, of course. But let's not do there. Let's come over here and just look at where Tesla's at today. And we got to kind of draw these two lines. And the reason I'm drawing these two lines, I'm just looking at where we're at today. And I'm just kind of showing you this is the range of where we're at. So I got to get rid of this because it doesn't like me drawing on it with that. So I'm going to come over here, drawing trend line. All right, so here we go. So now I can kind of put some numbers to it. So what's it selling at today? 205, high of 2. See, it's got a lot of movement, man. 202 to 229. Lots of movement in that period of time right there. And we're looking at August. We're kind of just looking at August. Actually, here, let's do something else. I'll make this a little easier. Let's go to 5 years. Okay, there we go. All right, so 227 and 205. So today you can buy at 205. How many of you think that's a good buy? And how many of you think that's not a good buy? How many of you think you'd buy low if you paid 205 for Tesla? Just looking at this chart. Is 205 low? Not low. I would agree, Brian. I would agree it's not low. Because if I were to go and to look at the history, and I go any longer like we just did a second ago, this is not really that low. That low would be down here. But here's a unique thing. And I'm glad we used Tesla, because in using Tesla, one of the things that's pretty cool about it is it's a relatively newer stock. I mean, it kind of really took shape in 2020. I mean, look at this. Before 2020, you could have bought this sucker for 19 bucks. Actually, got to ask, did anyone buy it at $19? Anyone? How about 20, 21? Anyone buy during this range right here? And I should say, not just buy it, but buy it and keep it between $17 and $90. Anyone? Okay, no. So here's what we're going to do. We're going to draw some lines here. All right. And when we draw these lines, I hate the way they do this, but when we draw these lines, what we want to do is like connect the dots. That's all we want to do. All of you have played connect the dots, and the dots we're going to look at is we're going to try to find levels here where we can connect. And we're going to count to 3, okay? 1, 2, 3. Everybody just see what I did? Let me draw a line to make this a little easier. Damn it. Come on, trend lines.
Chris, I'll be back in 3 minutes. Do Apple next.
All right, Apple's next. All right, so here we go. So now there I drew a little blue line. Now I'm just going to come back to my little drawing thing. All we did is connected the dots. Right here, 1, right here, 2, right here, 3. How hard was that? Was that hard, anyone? We just connected the dots. We just tried to find one point where this stock had 3 touches. Connect the dots. It touched here, okay, it ran up, but then it ran down. See how that did that? Okay, then it ran up. So it ran down, but then it ran up to this level. And we're going to get there in a second. Here, it ran down, went way below, but came back up and touched my level, played a little bit above it, didn't like that, and came back down. These are floors and ceilings. And here, ran up, and then ran back down and touched. So what we've got here is either a really good floor or a really good ceiling. That's all I want you to think about. So right here, we're going to call this the floor. Just look down at your floor. That's the floor. Now what we want to do is we want to figure out, okay, if that's the floor, where's the ceiling? Well, we got to do the same thing. So let's draw another line. All we're trying to do is connect the dots 3 different places. So here, I'm just drawing a line. Let's see, we got 1 there. And we could probably call that one because we could hit that. And definitely got 1 there. All right, so let's draw a line here. I'm going to draw it right there, 2, right there. That look good, folks? You can kind of see where I'm connecting the dots here. Now, if for some reason you draw a line and it doesn't really look good, what you can do is you can actually move the line. You can just grab it and you can just slide the line down if I can get it. It's not letting me grab it. Anyway, doesn't make a difference, but that's a good one. So now we know that this stock had 3 touch points for the floor, and we're just going to call this a ceiling. because we know it hit here and it couldn't go any higher. So it went down. That's a really good one. Then it hit here and it boosted up. I don't know, something happened there, maybe earnings, and it came back down and it hit it here and it came back up. So there's our 3, but we can even do more than 3. We could go here, and that's 1, because see, it went up a little higher. It's like, nah, I don't like that. I'm coming back down, and then hit it again. This is a really good ceiling. So if I was looking at a stock, and I was looking at it where it's at right now at 205, which is about right here, okay? I know there's a strong probability if things go up for Tesla, we're gonna go up to this line. Now let me get rid of this again. Like I said, my computer doesn't like when I'm doing that. So come over here, trend line, and we just need this. So that's 250. Now, how many of you would love to buy Tesla at 205 and sell it at 254? Every one of you. So why are you not? So you could easily buy Tesla if you think Tesla is going to go higher, and you could buy it today at 205, and then you would have to watch it when it gets around 250, you got to sell it, okay? Because after that, it gets a bit hairy. And all I'm trying to explain to you is after we get past this 250, this isn't a strong line, really. Maybe you could argue that this one could be it, but I mean, that's really no juice. And up here, that's like no man's land. Like there's nothing else to support this. So this is no bueno. We're really looking at these two, this floor and this ceiling. It was just done with a ruler. So if you bought it at 205, you had hopes that it's going to come back up here, which it could. See, it hit that day, just a couple days ago. But there's also a strong probability that it's going to go lower. And if it goes lower, it could go all the way down here. All right, so that's Tesla. Everybody understand that? Tesla might not have been the best one for us to do, but let's do the next one. Some of you are saying this is really boring. Let's talk IBC. I get it, but listen, like it's not building wealth, folks, is not about how much money you have or how much money you make. Building wealth is about how much you keep. I'm just trying to show you how to keep the money. I'm trying to show you how to be in control of the money, how to actually school your financial advisor, because you could start pulling this stuff out and be like, listen, I ran the charts. I ran the support and resistance. And right now, this is a good sell. All right, so we're going to do Apple next. We all know Apple, AAPL, and I definitely have that ticker right. So here's Apple, 15 years. This one's super freaking easy because we can just draw crazy amounts of lines. I mean, we're not going to go back that far. Matter of fact, actually, let's do this. Let's do Apple, but not 15 years. Let's just do Apple for 5 years because this will be a lot easier for us to look at. All right, so here we're just going to draw some lines. Grab your ruler, connect the dots. Okay, let's see. Anything there? Nope. How about there? That one look good? How about there? That one good? Anyone think that's good? I do. So we're going to just kind of connect the dots here. We go 134-ish. And notice I'm not really getting it dead on. It doesn't have to be right. It's kind of like Bob Ross when he was painting. Like he just threw paint on a paper and he kind of just made it whatever he wanted. It was never precise. It was kind of just like a bunch of blah, 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 mixed colors up. That's all we're doing here. So we got one touch point here, connect the dots. I guess you could say that's another one. I wouldn't go here because this is all the same level. But then here it ran up, hit this level. I'm going to use this level too. Okay. I'm going to use that one. But then it ran back down, touch there, super good. So now we got a really solid floor. Now let's just go up to the ceiling. I'm just going to borrow this little white line here. I don't know exactly what the white line is, but we're going to use it because it's easy. There we go. 182. So let's just put a line here. 182. All right. So we're just going right off of that line there. Get my little pencil. Touch point here. 1 touch point. I'll use that. 2. It ran down, kind of ran back up. 3, and then it ran back up through, which I'm not going to count that. I got 3. So I got an okay ceiling on this. So now remember the prices here. Okay, everybody remember the prices? We were at 182 for the high, and we were at 133 for the low. And where is it today? Can everybody see this up here? That's the price. And you see how it's live. This is where we're at today. If you had bought anywhere around these levels, would it not make sense to sell Apple today? How many of you would have sold Apple today? TLT, yes, JP. Anyone? I lost Steven for a sec, so I got to kind of come over here and look. White and yellow will be easier to see than the red lines. Okay, I'll change the color on my little pencil here. So you guys want yellow. Okay, we got yellow for you. Perfect. So you got that. There's 1. There's all our touch points. Thanks for letting me know that that color wasn't quite working. I wouldn't have known that. All right, so all I'm trying to show you is right now, Apple at 227 is high. And to prove that Apple's high, all we got to do is come over here and look at the history And if we just lay it on there, nothing changes. It's all the same. See how I can just lay the chart over it and everything stays the same? This was low down here. This is retarded. And you know who else knew this? Did anyone watch the news and see who else just sold a bunch of Apple stock? How about Warren Buffett? So what I tried showing you here, I know I'm just drawing a bunch of stuff. I told you this is 5th grade level. Some of you are like, man, can you draw a little neater so I can actually pay attention? You don't need to pay attention to what I'm drawing. I'm just drawing straight lines and circles, and you all said you could do circles, squares, and triangles. I haven't done triangles yet, but we could get into doing some triangles, but that's a little bit more than I think I wanted to cover today.
Hey, Chris,
So all I'm trying to do,
I saw Buffett just sold a bunch of more Bank of America also. Does Bank of America look similar to this, you think? Is that wonder why he's selling? Or does he know something else we don't know?
let's look at it.
We were talking about that on What the F this morning, actually.
I'm trying to think of what the ticker is. So I haven't bought, there we go. I haven't bought BAC, that's what it was. I haven't bought any stocks in quite a while. So there's 3 years, 5 years. Let's use a 3-year chart because that's kind of nice and easy looking. So let's see, draw lines. Here's Bank of America. This is right around where this will just kind of show you. So we come back here, let's start all the way over there and we just draw a line straight over. Super strong line. Now I know some of you can't see the little blue, but we got touch point here, touch point here, touch point here. What happened right here? Can anyone tell me? Can anyone tell me what happened right there? His name is Warren Buffett happened. And the rest of the market listened and they sold, driving the price down. But then the price went back up. So right now the price is going back up. So people that sold are like, oh, I shouldn't have sold, I should have held it. Wrong. Because if we really were to look at this stock and we were really wondering where is it likely that this stock will go, this is a bank stock. Well, I got tons of floors here. I could go here. So we could go down to $34. Today we're at $39. Where else could we go? We could go down here. This is what I don't like about Thinkorswim. Ever since Schwab took it over, it's not quite as neat for drawing. I could go here. I could even come way down here. And if I was really thinking things were going to fall apart, I could say that we could potentially see these levels, 27. Now, this bounce right here would be a great opportunity for people to get out. And again, see how now we're getting into more of these shapes. There's your triangle, upside down triangle. It went down because Warren, it bounced back up because of positive news of the Fed dropping rates. Where's it going to go next? Well, let me ask you this. Let me clear my lines. How many of you think Bank of America is going to break through and make these highs and try to get up here at the highest point we're at? Anyone? How many of you think Bank of America is going to come up, touch this line like it did here, like it did here, like it did, well, here it ran through, but how many of you think it's going to touch this line and go back down? I'm going down, okay? I don't think we're going above. I think we're going back down. So if you owned Bank of America, now would be a really good time to get out of it. What else we got, Steven? Let's keep going with these. I'm going to do maybe, what do we got? 141. I'm going to do maybe 2 more, and we're going to move on to the next part.
I'll let you pick. We got Microsoft, Ford.
I don't really care. I mean, I'll do anything, and all I'm trying to do is try to wake some folks up to say, like, listen, it doesn't matter what stock we look at. Literally, it doesn't matter. Outside of treasury bonds, which you should be buying because they work differently than stocks. See, the bonds, the long-term bonds right now are depressed in price because when the Fed increased interest rates over the last couple of years, it brought the price of the bonds down, bankrupting or making a couple banks insolvent because their value was all in bonds. And when they had to liquidate them to cover the bank run, they had to sell their bonds at a massive loss. It wasn't good for those banks, was it? But it could be really good for you because we know what's happening. The Fed's already said, Jerome Powell just said it. We covered it on WTF. We covered it on all of our things, including our 3-day money school essentials. The Fed has said they're going to start dropping rates. So when the Fed drops rates, what happens to the price of the bonds? Can anyone tell me if you've been paying attention? When the Fed drops rates, what happens to the price of long-term bonds, especially treasuries? Right, Yvette, goes up. That's all you need to know, nothing else. And then the only thing you need to know after it, if you buy it, all you have to know is when it's going up, you just got to pick your exit point, draw some lines. And just say, all right, well, hey, listen, if I buy it at $98, I think, I don't know, I'm going to sell it at 130. And all you need to do is like once a week, go on there and look, is it at 130? All right, I'm going to sell. And you click the sell button, call your advisor, be like, hey, dipshit. Yeah, sell that stock. Yeah, that one. I don't care if you think it's going to go higher. Sell it. I made my money. I'm not greedy like you. I made my money. Sorry, I love advisors, and we do get along with some advisors. All right, what else we got? Give me one, Stephen.
Let's do Starbucks.
Starbucks.
SBUX.
Did you say, yeah, SBUX? Starbucks is under new owners or new management. So this is probably an interesting one because I kind of figured this was going to happen. See this right here? They got a new CEO. It's got a private jet ride to work every single day that he wants to come to work. Not a bad freaking deal. And for that, the stock went way up because look at what was happening to the stock. It was going do 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 do. Whoops! Oh, we got a new guy that's got a jet. Let's buy more coffee. Awesome. This would have been a great place to get rid of Starbucks. This would have been a great place to get rid of Starbucks. Right here, probably a freaking decent place to get out of Starbucks. However, let's just draw some lines. Okay, I'm going to leave those circles on. I know it's going to kind of confuse some people, but listen, you ever look at a 5th grade or let's just use a 4-year-old. You ever look at a 4-year-old draw? Like there's lines everywhere. There's boxes and squares and circles and colors everywhere. So I want you to, I've told you, I'm going to teach you this like a 5th grader, okay? Or like a 5-year-old, I think is how I said it. And 5-year-olds have lots of lines and drawings and squares and circles on the thing. And that's why we're doing it this way. So here we go. I'm just going to do this super quick. Draw a line over here. Remember, I'm really not getting too technical about this. I'm just drawing some lines with a ruler. Let's see. And this is an easy one because we don't even need to try to find touch points. There we go. And then let's put one more on here. And then I'm going to draw some circles and stuff. 1, 2, 3. That's a good one right there. Ooh, that's a good one right here. Oh, yeah. All right. There we go. So now I drew a couple lines right here. $88. Okay. I've got 1, 2, 3, 4, 5. Man, that's a good connect the dots. Up here at 100, we got 1, 2, 3, 4. I'll call it 4, but you could actually make 5 out of that. That's another good connect the dots. And up here at this level, it's going to get harder and harder the higher in price we go to find dots to connect. Like up here at this level at 106, we got 1, 2. I got 3. But see, after that one, let me get my handy dandy, the yellow pen. After that one, man, she did not like it up there. Man, the stock did not like it up there at all. And it definitely didn't like it up here either. So we were just trending down. It tested it. It was like, oh, man, maybe. No, sorry. And then something happened. Probably, I think earnings came out or something. And then the new CEO came in driving this way up. I would say if you own Starbucks, man, I know their coffee can be pretty good at the airport. It's consistent. It's not good for you, but it's good tasting. I'd be out of this thing so freaking fast. Anyway, any questions on that? Get rid of my little drawings. There you go. Next stock. Let's do one more.
Meta.
Oh, yeah. Zuckerberg. Wonder what happened after he said nothing. All right. So 3 years on Meta. Let's draw some lines. Meta's another easy one. Meta would actually be better probably as a 5-year chart. No, I guess we can keep the 3-year. All right. So Meta. Let's draw a line here. Connect the dots. Is there a song that goes along with connect the dots? That would make this so much more fun. Like, anyway, let's just kind of go over here. There we go. Do we have enough there? We got 1, maybe 2. I'm struggling. 3. Yeah, I got 3. I got a solid 3. And that's all I need. And just, folks, just so you see, blue line, I'm just counting this is 1, this is 2, this is 3. Here we ran down, here we ran up, here we ran down. That's all I'm trying to do there, okay? Just trying not to make this stuff too complicated for you. Another line, grab your ruler, come up here to these levels. Let's see. I'd probably want to, and see how I'm doing this? I'm usually starting to the left because I'm going back in history. I'm trying to say, all right, this was a big run up. So something happened here. So I'm going to start there. Let's connect 1. And we ran down through 2, ran back up over 3. We'll call that 3. Let me draw you the yellow circle so you can see this. 1 here, and we'll go with 1 there. So we got 3. So now the question is, Meta, $515. Is it going higher? No? None of you think it's going higher? Why? Is that because there's nothing in 3 years that shows it being this high? Could that be? All right. How many of you think it's going to go lower? And then the question is, how low can you go? Is it going to go this low? Is it going to go down here about $320 a share? And I would say that's probably about as low as it's going to go, because if it goes any lower, we're going down in the $80 range. But you wouldn't want to buy a stock at $515 and have it go down to whatever this is, probably 450 or 400 or down here. You wouldn't want that. So that's meta. Any questions, Stephen?
It was pretty clear.
I mean, is that easy or what? It doesn't matter what stock we pick. Now I want to come over here and I want to hit on something that comes up every single time. And I get to have some fun with this. So Drew, thanks for participating. Thanks everybody for participating. Drew in the Q&A said, what if Apple, okay, so what if Apple, here, let me just pull Apple up again. I just want to do this the right way. What if Apple was bought at $20? $20, okay? What if you bought that sucker at $20? Listen, I think Apple's a fantastic company. Now, Drew, can you give me one more piece of information? Was Apple bought at $20 in an IRA or in just a standard brokerage account, taxable account? You put the standard account. Okay, so he's looking at taxes. All right, so let's just draw. Let me get down here. And now you're really going to make me go into the archives here. 20 bucks. How in the world did you buy Apple at $20, Drew? Holy crap. Taxman's gonna love you. So he would have had to have bought that around the latest would have been 2016 or sometime prior to 2014. So here's kind of how the stock went. I'm just going to kind of just draw it as a line like this. Went like this, went like this, went like this, and came down, then went like this, and then went like this, and went down, and then went like this.
It's a good time to talk about how unrealized capital gain taxes would work too.
Well, yeah, I mean, over 100 million. Anyone on here got over 100 million in assets? How unrealized would work is, doesn't matter whether Drew sells Apple that he bought $20. This is his cost basis. That's the amount he bought. It wouldn't matter that he bought it at 20 if today was the day that Kamala decided to pass that, if it ever made it through, at 226. He would have to, if he had a net worth of over 100 million. And I know some of you are like, that's only for the wealthy. Listen, I can almost tell you if they did push this through, it wouldn't just be the wealthy that would be doing this, because the wealthy would know how the tax code works. But I'm not going to play politics or semantics. We're just going to play this out. So he's looking at a $206 gain in a taxable account. Okay, that's heavy. Drew, how many shares you got? You don't have to share that, but could be a lot. Oh, that's right, Drew. You worked for Apple, so you got this as an employee stock. Sounds like charitable trust. Exactly, Jimmy. Charitable trust would be perfect for this, or a family foundation, because then he could take the gains and just shift them right over to a foundation or charitable trust, or some of them, like 100 shares. All right, so yeah. So he's got about 100 plus shares. So here's the thing. I guess you really got to kind of look at it and you got to say, is Apple going here or is it going higher? It's a simple answer. In the long run, Apple's going higher. No question about it. So Apple will go higher. So your tax problem, Drew, will get worse and worse. And depending on who gets in office, your tax problem will get really bad because taxes will go up. No matter who, I don't think it matters who gets in. I think one will be better than the other, but taxes will go up in the future. They almost are going to have to. So you're looking at a situation here of capital gains, okay? And I'm not a CPA, so consult with your CPA for tax advice, but we all understand capital gains. We don't understand unrealized capital gains, but right here, he's looking at a capital gain of 206, give or take, times 100. So if you took this today, let's just do some simple math, just to base it on 100, 206 times 100, you got a $20,600 taxable amount. Jimmy, what are capital gains at for someone making a few hundred grand? I could Google it, but since you're on here, what would be a good number to use for capital gains on something like this? Long-term stock appreciation here, 20% times 0.2. So your taxes, Drew, would be roughly, and I'm not using exact numbers, but about 4,120. Consult with your CPA. We're just ballparking it. So you're gonna pay $4,120 of your capital, of your gain of 20,600, but you are going to shield yourself around this going down. So on 100 shares, how much would it have to fall to lose 4,120 divided by 100? So $41, 41 times 100. So you would have to fall about 40 some dollars. Now hold on, here we go. So let's grab my yellow pen. So we got to fall $40. So today we're at 226, 226 minus 40 will go $41 because we're looking for a drop of $41. 185. Where's 185? About right about there. All right, so Drew, today you're here. That's how far it would have to go down for you to lose more than what your tax would be. 4,000, because if it'd have to drop $41, which is on 100 shares, 41.20 is your capital gain. That works out to be, whoops, that's not supposed to be a G, that's supposed to be a C. There we go. See how easy we can fix things? Bob Ross says what? There's not mistakes. I can't remember what he says. There's not mistakes. There's just happy. Anyway, I'll remember that. But there you go. Do you think it's likely that Apple will fall to that level? Is it likely that Apple could go down to this level? Is it likely that Apple could go down to this level? That's a hell of a lot more in loss than you would ever pay in taxes. That makes sense? So that's how I would do it. It's just a mathematical game. So you're saying, I mean, I don't really have a place I would put money right now. Drew, did you just join us? Like maybe long-term treasuries might not be a bad place. I'm just saying, you know, like, so there's not really a place I would put that money right now. Well, let's see here. I got it now. You challenged me. 226 times 100, about 22,000 bucks. $22,000. We'll use 22K. Get a black pen. Now I got to do this. 22,000 bucks. Like I said, you could buy that ETF that I was talking about at 98. High probability is probably going to go to 130 at least, which would be a small jump. So at 22,600 divided by 98, you could buy about 230 shares. Did I do that right? 230 times 98. Yep. So you could own about 230 shares of that TLT ETF. I'm not making a recommendation, just saying we're using this as an example. And if you bought 230 shares of that and that went up, let's say 30 bucks, 230 times 30 bucks, you'd make $6,900. But we got to factor in, you don't know where that money's got to go. You'd have to pay 4,100. So you'd subtract 4,120. So you'd net after taxes on this one, 2,780. Yes, you'd have some taxes on this one too, but you get what I'm saying? It's just a mathematical game, folks. Just play the math, run the math, consult with your CPA. Talk to your financial advisor. But if your financial advisor says, oh, we should stay in the market for the long run, realize what's about to happen. Just realize what potentially could happen after this election. I've done enough videos to prove that. Stephen, let's hit some questions before I move to the next segment. Was that enough number crunching for y'all? Did you like that? All right. Any other questions on this one? Yeah, I agree with you, Chris Ash. I don't think the capital gain, the unrealized capital gains would ever pass either. I don't think the 25,000 for first-time home buyers would ever pass it. You know, but it gets to a point where you got to start asking yourself is, in the future, are they even going to need anything to pass? Seems like they just push stuff through. Like, doesn't matter if it's passed or not. They're just kind of pushing it through. Like, just let me just use the student loan thing, for example. How many of you remember when the Supreme Court ruled down the Bidenomics plan to pay off college, you know, your college loans? Remember how they struck that down, but yet they still did it. They found a way around. So I agree. I mean, there's no way in hell that would ever pass because the people that are donating to these campaigns, the people that are in charge all have probably over $100 million. They'd be the ones that they'd be hurting. They'd be hurting themselves. Yeah. Yeah. Oprah, sorry. You wouldn't want that unrealized capital gains. No. But then they got incentives for new home buys or new home building and they're planning. I just did a video, folks, and it's all about like the economy under Kamala. So I did one, the economy under Trump. Now I did the economy under Kamala, and I tried staying pretty neutral as much as I could. I don't hide that, you know, I'm a Trump voter, no question asked, because I can give you a whole hour and a half of why I would vote for him and not Kamala, but we're not going to get into that today. And each of you have your reasons for who you vote for. Doesn't matter, you know, just is what it is. All right, we good on that? Let's move on. This is the one that came to me in the shower. And folks, this isn't going to be exact because I did this kind of thinking, what's the easiest fifth grade level to show this? But you all know that when we build these banking systems, we talk about changing one thing, and that is where your money goes first. So the money that you save is the money we're referring to. So if you're saving money in a bank, you're saving money in a 401k above and beyond the match, you're saving money in a brokerage account, what we're talking about is that savings and changing just where it goes first, not where it stays, just where it goes first before we make investments into things like real estate, private lending, anything, paying off car loans, paying off student loans, paying off credit card loans, all of that. It's just where the money goes first. And we talk about a process. So I've done enough videos and enough wealth webinars where we go into all that. So today I just wanted to do one where I explain the fundamental differences between good old-fashioned whole life, which is the oldest. Okay, so whole life is like the great-great-great-grandfather that you knew or you heard about, but you never really fully understood it. Okay, that's whole life. It's been around the longest of them all. In the 80s, universal life made its debut. What was his name, Stephen, the guy that kind of bastardized whole life and also the Corvair? What was his name? There you go, Nader. So Nader kind of bastardized whole life, saying it wasn't transparent. So on came the new version, which was universal life, which was transparent. The thing people don't like about whole life, or more so back then when Nader was doing it, is everything's kind of baked in, right? So when we look at your cash value or we look at a whole life policy, it's very difficult, almost impossible for me to extract the actual cost of insurance. So I just want to start there. All of these different life insurance policies, from whole life to universal life to variable universal life to IULs, and I'm just going to come over here and write term, but term is super easy to explain. They all have a cost of insurance, the cost for the death benefit. Okay, so but the way the cost works on all of these is very different. Okay, the way cost of insurance works in whole life is drastically different than universal life, VUL, IUL, and term. Because all of these, term, universal life, variable universal life, and IUL are almost all identical. They are all working on what's called a yearly renewable term. So in other words, the one certain that we all know is every year we get older. We celebrate our birthdays, we get older, we wake up the next day, and all of a sudden we can't get out of bed without a cane. Just kidding. But we know that. Every year we get older, and every year, from a mortality standpoint, we are 1 year closer to the day we graduate, meaning the day we go on to heaven. We can all agree on that, correct? So if you were an insurance company, you would know that each year the cost for the death benefit that year is X. Okay, that's your cost. Term. If you're 30 years old, the cost per unit, or just use per $1,000 of death benefit, is X. I don't know, whatever it is. But then when you're 40, the cost per unit of death benefit is more because you're older, because you're closer to the graduation date. So your cost goes up. I want you to all look at these ones, because all these universal life ones are the same as term, because they are all annual renewable term. Every year, as you get older, which is this axis here, your cost goes up. But the cool part about universal life, VUL, IUL, they're all the same chassis. Okay, so think of them like a Chevy. Like think of a Chevy Tahoe. A Chevy Tahoe is pretty much the same chassis as a Cadillac Escalade, same chassis as a lot of other vehicles. It's just a chassis, and then they bolt stuff onto it. But if every year you get older, your cost goes up, who does that benefit? You or the insurance company? Who does that benefit? Does anyone know? If when we get older, closer to the day we graduate, closer to the day, Yvette, you nailed it, both. That I didn't think anyone would get that. I was trying to make it so that everybody said the insurance company, but no, everybody wins. Because if the cost is lower when you're younger, your cost is less today, because you're never going to be younger than you are today. And if the cost is more when you're older, like 80 to 90 years old, the insurance company wins. So really, there's this kind of fine line in the middle where we kind of have to start to ask ourselves, when do we think we're going to die? Well, nobody's got this done better than the insurance companies, and I can prove that. And actually, here, let me just prove it. Why say I can prove it? Why don't I just show you? Percent here, I'm gonna just do this live for you. I think some of you probably have done this on your own, but let's just say percent of term policies that pay death benefit. There we go. There we go. I mean, we could keep going, but anyone have any questions? 99%. 99% of every term policy that Dave Ramsey tells his clients to buy, 99% of every term policy everybody buys will never pay out a claim. So the insurance company knows this. The insurance company's on the hook for 1% of all the term policies. So knowing that, does that make term insurance the cheapest, or does it make term insurance the most expensive life insurance you will ever buy? Is it the cheapest, or is it the most expensive? Okay, great. I love this. I got two answers. Hold on, let's stop there. Eve said most expensive. Yvette, I'm sorry if I'm butchering your name, but Yvette said cheapest. It's a matter of opinion. And here's the best way to explain this. If we know that term insurance only pays out 1% of the time, and the insurance company knows this, that does make it the most profitable product that any insurance company could sell. Because I would love a product that I only have to fulfill on 1% of all the products we sell. Okay, only 1% has to be fulfilled on. And that, yeah, Stephen would love that. We'd be like, holy shit, we'd be printing money. Well, insurance companies do print money, and thank God for term insurance. And thank God that they know that you're not going to die within the term of time you buy the term. So here's what you buy term insurance for. You only buy term insurance to protect something for a freaking term of time. Your car loan is 5 years. Your mortgage is probably 30 years. Your student loans, call them 20 years or whatever the term is. Whatever you are protecting has a definitive time. Folks, it's right in the name of the damn product. It says term of time. That's what you're buying. You're buying protection. You're technically renting protection for a term of time. And if you're trying to protect your family in the event that you die, you will lose. Go to Las Vegas and look at all the beautiful lights in the buildings and all the roller coasters and everything on the strip. Do those things get built because the casinos lose to you? F no, those things are built because they know you're going to lose more than you're ever going to win. Insurance companies know that you're going to lose 99% of the freaking time if you buy term insurance. So that is a losing proposition. But for an insurance company, that has them in the back room going, ho, 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 we need to design a lot of products around that, because that sucker right there, man, we nailed it, and we need more products like that. Hence comes Universal Life. Back in the 80s, Universal Life came out, and it was great because back then, all they did is they designed a product around a term chassis. Every year, your cost of insurance goes up. No ifs, ands, or buts about it. Next year, your cost is more. The year after, your cost is more. And when you get around the day when you're going to probably pass, your cost of insurance is going to be super freaking expensive. But they were like, it's okay, because we're going to add this thing called cash value. And what we're going to do is we're going to kind of figure out what the cost per unit of insurance is when someone's young, this period. And what we're going to do is we're going to take the difference of what you put in, your premium, and we're going to have that go to this thing called cash value. And then we're going to put an interest rate on that cash value. Back in the day, this was 4%, which is awesome. This is when I sold Universal Life. It was 4% guaranteed. But the current interest rate when I started was like 6.2. Man, this was the easiest product in the world to sell. I would go to clients. I'd be like, hey, we got this awesome product. You can put money into it. You're going to get a death benefit. Okay, so if you die, your family's going to get a death benefit. Unlike your term, this product goes to 100, well, back then it was 100 years old. Mortality tables changed, but if you live to 100 years old, your family's going to get a death benefit. We're going to build cash value at this interest rate of 6.2%, and we're going to illustrate it at 6.2. Yeah, there's this column over there that says guaranteed, and that's only at 4%, but this is where you're at today, so this is what we're going to focus on, your current interest rate at 6.2, and everything's good. And folks, these things illustrated amazing. When I was selling these in the early 2000s, man, I'd have somebody putting 50, 70, I'd have somebody doing $70 a month, and man, they'd have hundreds of thousands of dollars by the time they're at retirement age. It was like so easy to sell until interest rates went down and down and down and down and down and down. And then the Great Recession hit, and they went to almost zero. And then all of a sudden, we weren't illustrating these things at 6.2 anymore. No. Now the client's getting a letter saying, hey, just so you know, you're at the guaranteed interest rate, which luckily is at 4%. However, based on current assumptions, based on the interest rates being at guaranteed levels, when we run your illustration out to age 100, you're going to lapse when you're 70 years old. Your policy is going to lapse. We, the insurance company, are going to win when you hit 70 because your policy will be no more. And all that cash value you built up will be gone. So the cash value in this policy, when they illustrated, was this green line. But then when interest rates changed, this green line kind of went like this, because now the cost of insurance was so high that it literally was eating away at your cash value. So the client had a decision. Here's the decision. pay double or whatever the premium would be. We signed up at 70 years old, but sorry, now you're going to have to pay 100. You got to pay $100, otherwise this policy is going to lapse. And we could literally meet with the client and say, okay, you want to put 100 in? Great. You're going to make it till 78. Okay, no, you want to put 200 in? All right, well, now we're at 100. So we went from 70 to $200 a month in premium, and now you're going to make it. Does anyone see a problem with that? I will tell you it was a huge problem. I lived through this. I physically saw this happen firsthand. So when people like my newest Instagram post want to hate on me for talking down on IULs and talking down on the way IULs are sold, they are all built on this chassis. And guess what I saw? I saw this completely collapse. Here's what I did as a career, and I made a lot of money, hundreds of thousands of dollars as an advisor. I was given a list, literally. New York Life gave me a list of clients. They were called Target Universal Life policies. And what they said is all of these policies are going to lapse in the next 10 years. Go out, talk to the client, meet them at their kitchen table, show them this, and tell them that their policy is going to lapse. And here's the amount that they have to put in order to that policy to make it to age 100, because everything was 100 then. It's now 121. So that was my job. I got to call these people, and I would never tell them on the phone. I'd be like, hey, yeah, so-and-so from New York Life. Hey, your agent's no longer with the company, but what I'd like to do is come out and do a review of your policy. There are some very important things we must discuss about your policy, some good, some bad, but I need to show you your options. Every time they'd have me come out. So I'd get in my car, drive an hour, 2 hours, 3 hours, however far I had to go out to the middle of bum FU USA, and I'd meet with these people at their kitchen table, and I'd show them this. And people would literally cry because they had this policy that they barely could afford. They're just hanging on to it because they want the death benefit for their family. And now their premiums double. That sucked, folks. It sucked. And the exact same thing that happened then is going to happen in the future with IULs. Because now let's go to the next round. We got any questions on that? I don't mean to be gloom and doom here, but folks, I saw this happen firsthand. And then there was this new product that was born. It was born out of the rave for buy term invested difference. You see, the insurance companies loved buy term invested difference. They're like, this is fantastic. However, the insurance companies were like, this kind of sucks. We're selling a boatload of term because these assholes are pitching this buy term invested difference, but we're missing out on all these invested dollars, this difference. So why don't we create a product where we take the term that everybody loves because it's cheap. Some of you already figured that out. It's the most expensive life insurance you can buy because it probably will never pay out. We're going to sell this term, but then what we're going to do is we're going to get those invested dollars, that difference, and we're going to do it all in one wrapper. And because it's life insurance, it's going to be tax-free. This is going to be freaking great. We're going to go after all those high net worth clients that don't want those taxes on their investments, that are doing buy term invested difference. We're going to give them one product that gives them term that never ends with a sub-account of investments. Born was the variable universal life. Variable standing for variable cash value, variable returns. So here's how that one worked. Same thing as the universal life, folks. The variable universal life, and these are still sold today, had a increasing renewable term. So every year, your term, your death benefit, which made it all the way to 100, today is 121, every year you're guaranteed to have it be more expensive. But the cool part is now we could take that money and we could come over here and we're going to give you this sub-account. That's what it's called, sub-account of mutual funds. And we'll give you these big prospectuses. Folks, I used to travel around back in the day. I would travel around with a prospectus this thick. Man, I had this thing in the trunk of my car. It was like a big box, and all it did is have these giant prospectuses. Folks, you would need glasses with magnifying glasses on them to read the print on these tiny little paper-thin pages. Anyone old enough to remember the old prospectuses that you would get? Anyone? Yeah, they were nuts. Nobody read them, but I had to leave it with the client because that was my compliance. So I'd go out there and I would say, hey, listen, what we did is we created a product where we can have the cheap term, but it never ends. That's awesome, right? Yeah, that's pretty cool. You're buying term and it never ends. But what we're going to do is we're going to take the difference and we're going to give you all these investments that the insurance company put together. And that a lot of the investments were the insurance company's mutual funds. And we're going to let that money, that difference, go into these mutual funds. And because it's all in this wrapper of life insurance, it is tax frickin' free. Woo, did I sell a lot of these things. I even bought one of these sons of bitches. And you know what? It was freaking awesome. I thought I had the greatest product on earth until 2008. And in 2008, these sub-accounts went negative. And I don't mean just a little negative. I mean like 20, 30% negative. And when these sub accounts went negative, guess what it did? It made it so that my premium I was paying in, which was flexible, and it was sold to me, hey, your premium's flexible. Yeah, you can put $100 in this month. You can put $200 in next month. You can put $50 in the month after. It's totally flexible. Put in whatever you want. Here's your target premium. This is the amount we're recommending based on current assumptions that you should put in. And it's $50 a month. So that's your target, but you should probably fund it above the target. That's what we called it. And we did this. And then when everything tanked, my policy included, I got letters from the insurance company, from the company I worked for, saying, based on the performance of your sub account, your policy will lapse in the next 3 years. I actually think it was sooner than that. I think it was like, it was going to lapse, period, because there was no cash value. And at that point, my cost of insurance was more than the premium I was putting in. I don't remember how much I put into that, $100 a month, maybe. Okay. My premium was not enough to cover the cost of running that account. Now, the cost to run a VUL and the cost to run an IUL are not just the cost of insurance. There was the cost of insurance, there's the 12B1 fees, there was the management fees, there was the sub-account fees, and more fees. But they were all baked in, boiled in. All right, so anyone have any questions of where VULs were problematic? A lot of them lapsed, just like a lot of the ULs lapsed. I'm wrapping this up, but you all see where I'm going with this. Now, today, the biggest thing out there and the thing I get the most amount of hate on social media is just a hybrid. The sister of the nasty sons of bitches called universal life and variable use universal life is now the IUL. But wait, there's more. The IUL, you can't lose money like you did in the VUL because you're not actually investing in the mutual funds. You see, us, the insurance company, what we're going to do is we're going to create a sub account of indexed funds or indexes, and we're going to buy derivatives. Okay, we're going to buy derivatives, and we're going to basically do this whole hanky-panky stuff with our Harvard analysts and our CFAs over here, and we're going to get returns, and we're just going to let you participate. We're going to let you participate. But that means because you're participating, you have a floor of 0, and you have a cap, okay, that we can change anytime. Some of you that have IULs have had this happen recently where they've changed your cap. You started with a cap of 10, which means the most you can make, cap, just like it sounds, the most you can make is 10% if that was your cap. If you were a 10 cap, you couldn't make more than 10, but you can't make less than 0, okay? So that was your cap, but the insurance company can reduce this cap. So now you might be at a 7 cap. So now you can make 7, but you can't lose money. But wait, there's more. There was recently a lawsuit. There's been lots of lawsuits, but Pac Life has to pay out a couple $1 million. And this is that Instagram video I put up that I'm getting a bunch of haters. And the one guy's like, you didn't even read the article. It's this, this, this. And I said, does it matter? It's just showing the weakness in these products. It's showing these products are being sold wrong. These advisors or agents, because you don't even need to be a freaking financial advisor. You don't even need a securities license to sell an IUL because you're not buying an investment. You're participating in an investment. And you know, the fine print on those contracts, I used to have them over here. I think I got rid of them because I got sick of looking at it. But the fine print, no, I do. Holy crap. Look at this. I do got it. Hold on. This will be fun. Pac Life. Here it is. See, I've got a bunch of these investments. See that one, Pac Life? That's the one that's just got sued, okay, and lost. Here's another one, Minnesota Life. These are IUL illustrations. We look at these all the time. But not only that, what I've done, I did a YouTube video where I went through and I highlighted all the sections inside the illustration of things that none of you would ever understand. Not in a million years would you understand what this shit says. You wouldn't have the slightest freaking clue. But I did highlight areas that you would understand, like guarantees. What guarantees do you have? The values shown as guaranteed in the illustration are calculated using the guaranteed minimum interest rate and guaranteed maximum administrative and insurance charges. These values are also based upon premium, partial surrenders, and loans displayed in the illustration, which means no loans, no surrenders, no withdrawals. If you took money out of the policy as a loan, it's going to blow this whole son of a bitch out of the water. But see, then it even went further. See, I just tried finding some illustrations that would actually show better than what actually, like, was there ever an illustration done that actually has performed better than the illustration was hypothetically designed to show? Well, this one here, which was done by somebody I know and respect, and he said, this is the best one. First off, you put 12 grand in and you can use 8,107, which was good. It was 67%. That's the best IUL I've ever seen in the first year. But then when I ran the numbers, I'm like, this thing's a piece of shit. But they also ran this at 6.25%. But see, if I'm looking at this illustration, I don't look at this fine print, I would never know that this thing, to get these kind of cash values, has to perform at 6.25. How many of you think this thing is going to participate at 6.5% every single year forever? Absolutely, almost impossible. Matter of fact, so impossible that FINRA, the regulatory agency, the Financial Industry Regulatory Agency, has come out and put warnings out about these products over and over. Reg Notice 13-31, business conduct problems, like these are being sold. They're complex structured products. I highlighted it all. People are trying to tell them they should move the retirement plans into them. And it just goes on and on and on. But I did this whole thing, and then more articles about IULs. Are you sick of hearing it? Here's more. Advisors beware, the downside of behavioral finance, all about IULs. I forgot I had all this. Folks, like, I've done my research on IULs. The verdict is out. The jury is now out. They will fail, just like the universal life failed, just like the VUL failed. These are next. These are next.
Well, here's a common kind of conception, I guess. Yvette said, my IUL has a 0 floor where you do not lose money when the market goes down. You want to hit that?
Oh, yeah, I was hitting that. Remember over here, I said you have a floor of 0%, okay? You have a floor of 0%, but that means you can't lose money in the participating indexed account. That doesn't mean you can't lose money, because if you make nothing, Yvette, does the insurance company still charge you for that death benefit, that cost of insurance? Yeah. Next year, if you make zero, will it be more? What?
Sorry, she said it goes down every year, her cost of insurance.
That's physically impossible. It's impossible. Somebody's lying to you, or you're reading something wrong. Your cost of insurance has to go up unless you're reducing your death benefit every single year. I don't mean to be like stern or rude, but you're wrong. It can't happen. Your death benefit cost never goes down unless you set your policy to have a decreasing death benefit, which why in the world would anyone buy life insurance with a decreasing death benefit? Nobody would. They would either buy the death benefit as a level death benefit or an increasing death benefit. It's the only two ways that I've ever seen them.
Even a level death benefit, like it said with the term, which term is usually level, right? It's still losing because of inflation. So instead over a 20-year time span, I mean, it goes down 56%, right?
Stephen, I got to say one thing. When I say level or increasing death benefit, I just mean what you can do is you can set the option so that your death benefit stays level. So let's just say you took out an IUL at $100,000 death benefit. That means your death benefit's always $100,000. An increasing death benefit would basically kind of like a whole life and paid up additions. Every year, it would use the cash value growth and the performance to increase the death benefit. Has nothing to do with the rising cost of insurance, because the rising cost of insurance in every single universal life, IUL, VUL, all of them, is renewable term, yearly renewable term. It's in your contract. Read it. Oh, I'm sorry. Your contract is so complicated you don't understand how to read it. I get it.
Well, here we go. So the truth comes out. So the premium stays the same and does not go up.
Correct.
Level.
Premium's level.
But the cost,
that doesn't mean anything that your premium's level. You have flexibility. All universal life has flexibility. You could set your premium at 500 and you have the ability, you could drop it down to 100. And the problem is, if you did that, you wouldn't realize the problem until it was almost too late. Like I explained up here, like I explained over here, it would be too late by that time. I could go all day long about IULs. Folks, I have too much knowledge in this stupid head. I don't even want it. I want to just offload it to somebody else, like Chris Kirkpatrick. You tell people why IULs are bad, or bring in way smarter people that have PhDs to show people, not picking on you, but to show people, you know, why IULs are problematic. Like, don't listen to me. Listen to a PhD who has a doctorate in this. Like that's the people you want to listen to. And I've had them on my YouTube and also on this channel. I'm not trying to beat up on IULs. IULs have a place in the marketplace, and it is a place way out in the future, and good luck getting there the way that it's illustrated, because it isn't going to probably happen. Whatever your illustration shows, just know it's probably going to be somewhere between guaranteed and current illustrated. It's a midpoint, which most of the time they don't show you. That's all you need to know. And you're going to be disappointed. That's the other thing you should probably need to know, because anybody that has had an IUL, and we have worked with hundreds of clients, if you had an IUL, all I can tell you is none of them during the biggest, longest bull run we've had have outperformed the hypothetical illustration that was provided to them. None of them. I've never seen one. We have a $10,000 challenge. So Yvette, if you've got a policy and an illustration that has performed better today than it did. And there's some rules. I think it's got to be longer than 5 years or something like that. Chris Kirkpatrick has the rules for it, but I got $5,000 on the table for somebody that can show me an illustration that has outperformed what they initially were given. Do you realize we've had this challenge going for over a year? Not one person has taken advantage. It's $10,000 freaking dollars. Not one person has come forward with it. Why would that be? Is it because we're trying not to advertise it? No, we advertise it on all the different stuff me and Kirkpatrick do. Every time we advertise it to tens of thousands of people. Nobody has come forward because nobody has one. That's why. None of the illustrations in a bull run, in the biggest bull run, longest one we've had, have been able to outperform what was illustrated. You tell me that's not a problem? It's a lawsuit. That's a lawyer's wet dream. Because they know it, they've targeted it, and they know they're going to go and they're going to sue all the insurance companies, and then the advisors are going to get reprimanded and probably get different, what do they call it? Anyway, I'm going off on a tangent, so I'm done with that. Now, stupid whole life. I didn't talk about stupid whole life. Why is whole life different than all these? Well, whole life's different because the cost of insurance is level. Day 1 to day 121 never goes up. Now, that's good and bad. Kind of how Yvette said that earlier. It's good and bad because that means you're paying more today for the cost of insurance than you would with a UL, an IUL, or a VUL, because these are going to be cheaper. Just like I illustrated, these are going to be cheaper in the early years. But please let me ask you a question. How many of you want your cost of insurance to be more when you're younger than it is when you are older? Or how many of you, let me rephrase that, how many of you want to pay more when you're getting closer to the time when you will more than likely graduate, and more than likely where you can afford it because you're not working, you're retired, you're on a fixed income, and Social Security is just bullshit? You want your cost of insurance for your life insurance going up then? Or do you want to pay a little bit more during your working years because the cost of insurance is level, so it means it's higher today? I'm not a stupid man. And I will tell you, every single time, give me the higher cost today so that my family is taken care of when it actually freaking matters, which is later in life. Which is why whole life has and always will be the reigning champion when it comes to life insurance. And it will also always be the only product that works for the infinite banking concept because the costs are fixed. They don't change. And the other thing that's nice about it is they have this beautiful thing called guaranteed interest. And that guaranteed interest is very different than the universal life because the guaranteed interest here is factored at a fixed cost of insurance. So if we look at the guaranteed tab on all whole life insurance, you bet your sweet ass that's exactly what you're going to have. Now, we then add the variable. Okay, the variable over here was the current interest rate in ULs, was the participating rate in IULs, was the separate account investment performance on these, all very variable. The variable over here in whole life is a dividend. And if you do a whole life policy through a mutually owned company, which are the only companies we work with, the one thing I will tell you is every company we work with have paid dividends consecutively every single year since the year the insurance company opened, which is every one of them is over 140 years old. Never missed one, not through the Great Depression, nope. Not through any World War, nope. Not through any of the plagues, nope. Not through the 80s crash, nope. Not through the dot-com crash, nope, they continue paying. Not through Great Recession, nope, they continue paying. The pandemic, they had to have stopped paying dividends, nope, they continue paying dividends. And they will continue paying dividends because the dividends are a major component of a mutually owned insurance company. All these companies over here with these IULs and VULs, most of them are publicly traded. Who benefits in a publicly traded company? Folks, we don't need to be smart here. The stockholder, not the policyholder. Who benefits in a mutually owned life insurance company? The policyholder, because that's all there is. They're like owners of the company. It's a drastic difference, folks. Drastic difference. But not only does whole life have a level cost, okay, and I put that, cost of insurance is fixed. Whole life is the only one where when we look at an illustration, we can see exactly what it's going to perform at. None of the other ones can do that unless you look at the guaranteed. And Yvette, I don't mean to call you out, but look at your guaranteed column of your IUL. When does it lapse? Just asking for a friend. Because I bet you it's not 121 years old. I bet you it's not even 100. Look at your guaranteed tab. Not saying that's ever going to happen, Yvette, but hey, if we're comparing apples to apples, we're looking at the guaranteed tab of the whole life, and we're looking at the guaranteed tab of the IUL. When does yours end on the guaranteed level? Because I'll tell you when the whole life ends, 121. And I'll tell you another thing about the whole life. You are guaranteed to have more cash value every single year that goes by. In the IUL, VUL, UL, you are definitely not guaranteed to have more cash value every single year. Matter of fact, your cash value at a certain point is probably going negative or going down. And that is because your cost is going up. This is not complicated. And this is exactly why I fight so hard to tell people why this stupid product called a whole life insurance policy is and always will be the only one that works for the infinite banking concept. So you want to create your own bank, you want to take back control, you want to do all the things we teach, that's the only product that will work. Period. Okay? Now let's go one step further. People over here in Universal Life, VUL, IUL, they all love flexibility. Oh yeah, my premiums today are 500, but I can reduce them down to 100. Guess what? Because of the way that whole life has evolved, using paid up additions, which is a rider, essentially money that we put into paid up additions goes right into the cash value. Freaking awesome. Because we have that, we can build those same things because we're freaking smart and we're good at building policies. We're so good at building policies. We have literally set the industry standards with videos that have, I don't know, how many views does that video have? I'm not trying to toot our horn here, folks. I'm a bit fired up because like sometimes I just can't understand what part of this people don't understand. Kind of like when I was saying, I don't understand what part of the buy low, sell high people don't understand. So here's one, 94,000 people have watched that one. Here's the newest one, 57,000. I've literally dissected in this video. Here, I'll put it in the chat. So if anyone wants to watch it, I have dissected exactly how to build a policy with flexibility to be used for the infinite banking concept. I'm fired up. Jen, you freaking rock. And Jen's here for the first time and I got her fired up. But like, seriously, like this is the truth. Okay, I'm trying to, and I might be missing some details, but I'm trying not to put someone to sleep. I'm trying to be excited about this. Because of paid up additions, I can do the same thing the IUL can. I can build a policy which has a ceiling of 500 and a floor of 100. Piece of cake. Craig's like, shit, we do that in our sleep. And we can build it so that even if we go to the minimum, the policy will never lapse, which I absolutely cannot say for the IUL. A matter of fact, I bet you there's probably never one time in an IUL, a VUL, or maybe even a UL, UL might have a chance, but there will never be one time if you fund it at the minimum level, your policy will make it to the finish line. The finish line is the day we die, if anyone was wondering. The most important day when life insurance becomes really freaking important. Listen, whole life insurance, we make it important in the first 30 days because we access the cash value through loans. We use it for the infinite banking concept, but I still might be the only one here today, or one of the only ones here today, who have delivered as many death benefits as I have to the widows of the fallen, the widows of the people who passed too soon. I have delivered more death benefits. And I'll tell you something right here, right now. There is nothing more important in what we do as a company than deliver a death benefit to a family that needs the check. Because at that time, when you lose the loved one, everybody is coming at you with an invoice for the gravestone, an invoice for the casket, an invoice for the flowers, an invoice for the party you had to throw, an invoice for the food, an invoice. We are the only ones bringing a check to the table. That has an importance that I can't express in words, but I've done it over and over again. And I know we always talk about the importance of cash value, and it is. It's awesome. Having the access to your cash value, having flexibility to put what you want in, all the things we teach are awesome. But there's nothing more awesome than knowing that someday when you graduate, your family is getting a check. That is the ultimate. That is the ultimate. I can't say that for these. Universal life in today's world is not as prevalent in the marketplace, but universal life today has what's called no lapse guarantees. So this product actually can make it to 121, no ifs, ands, or buts, as long as you make the premium at the no lapse guaranteed premium level. VULs, no guarantee there. IULs, I don't know. Maybe they've created a product or two that have guarantees, but most of them will not make it to that day. Most of the agents selling universal life will not even be there for their client the day their client passes because they're in it for the quick buck, because IULs pay the highest commissions of any product that I've ever seen. So when the day that matters comes, When a loved one passes away with that IUL, is there going to be a death benefit that's delivered? Maybe is the answer. And that's just not good enough for me. Because in the word whole life, there is one thing I can tell people. The day you graduate, when your family will need this check, I can guarantee you there will be a check for them. But on you, Mr. Client or Mrs. Client, you have to make sure you follow through with your obligation, which is we built the policy with a max funding of 500 and a minimum funding of 100. You have to make sure that you make your premium deposits within that range. And if you do, there will be a death benefit paid out. What questions do we have?
I do. Yvette's going to send me her policy. She thinks she might have the $10,000 winner. So we'll see.
Well, she wouldn't be the one, and sorry, Yvette, you wouldn't be the one that would get the 10,000. It would have to be the agent. So it was really something that was to the agent. So get a hold of your agent. And if you meet the criteria, go to Chris Kirkpatrick's website, and I'll give it to you. But yeah, if you've got one, you would get 10 grand. I'd be happy to pay you the money. But you just got to hit those.
Let's see. Roxanne, I have a term policy now. My agent is suggesting converting to blended whole life plus term, which eventually will convert to full whole life.
Yeah, great. Yeah. So all you're doing, so here, can I go to another screen?
Yep.
So what you've got, whoops, let me get rid of this IOU thing. We don't need this anymore.
Yeah, she has a term policy now. The agent is suggesting converting it to a blended whole life plus term, which will eventually convert to a full whole life.
Yeah. So you have a convertible term. Okay. Not all term policies are convertible, which gives you the ability in a certain time frame to convert all or some into a whole life. Now, they're going to sell you a base whole life, nothing like the ones we designed, but you could say, hey, I want to convert it into a whole life, but I want the majority of the premium going to the paid up additions. And as long as, so how convertibles work is if you got $1 million term policy, you can convert up to $1 million of death benefit with the whole life. That's it. So when we put premium dollars into the paid up additions rider, which is what you would say, paid up additions, because that's, if you want to design it right, watch that video on my YouTube channel, show that to your agent, tell your agent to design it that way, send us the design. We'll tell you whether he did it right or wrong, he or she did it right or wrong, and we'll send it back. And then, yeah, then that's a great thing. Because if you've got the whole life, you no longer, or you got the term, you no longer need to go through underwriting to get a whole life. And that whole life could be a blend, right? And the blend is, just like we designed so many, there's the base, and then there's probably a term rider. So you could carry over some of this $1 million term into a term rider inside the whole life, hence making it a blend of whole life base with a term rider. The only thing that's missing is the paid up additions. So you want to make sure you hit and ask, can we design this with the maximum of the premium dollars going into paid up additions? They might not be able to do it for you, or might tell you we can't, but it can be done. We've done it a lot. Go ahead, Steven.
I think we're good, man. Hit all the questions. Right. Everybody's saying this is awesome, man. Thanks for explaining to you with IULs and ULs, you know, what they look like and how they operate and what's good for BYOB.
Yeah, and I agree with Karen. So I did get a little carried away. I started using a lot of terms that maybe she wasn't understanding. I get it. Again, you kind of sometimes got to be around the campfire a little bit. Some of these terms are, outside the norm. So you just got to kind of get used to it, like PUA and term. And I was running out of time, so I was going quick. But Karen, just kind of watch a few of the videos and you'll get a little bit familiar with the terminology. You just got to kind of, there's no simple way. I've been doing this 21, almost 22 years now. So it's just like second nature to me. But hey, folks, thanks for letting me kind of get a little silly and a little crazy today. I hope I didn't offend anybody. Yvette, if you do have a illustration that meets the criteria, we'll send you, Stephen, if you've got Yvette's info, send her Chris Kirkpatrick's video giving the guidelines for it. And they're not hard. You just have to have an illustration, or you have to have had an IUL around for, I can't remember if it was 5 years or longer, and you have to be able to show the original dated illustration and an in-force illustration beyond the 5 years. And if the in-force beats the original, winner, winner, chicken dinner, 10 grand. Awesome. Well, with that being said, folks, thanks all for joining us for another episode of Wealth Webinar. It's been a pleasure and honor. And thank you all for letting me kind of get funny and silly with explaining this stuff. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.